so much, Wayne. Well, welcome, everyone, and thank you so much for joining us today for Thinking Beyond the Checkbook. We'll talk a little bit about tax-advantaged ways that everyone can be more charitable. I do have my colleague on the line, Dave Cavell from Whittier Trust. So I'd like to give him a chance to introduce himself as well. But first, let me just take you through our agenda for today. We're going to spend a little time doing introductions, and then I'd like to talk about planned giving. Next, we'll have some tips and tricks and some ideas for tax-advantaged donations. And then I have just 2 slides at the very end about limited time opportunities. Wanted to make it sound really exciting, but there are actually 2 time-sensitive opportunities that I'd like you to be aware of. So we'll get to that. There's only about 20 slides, and I certainly would welcome any questions as we go through the presentation, whether you'd like to chime in during the presentation itself with a question, please do, or if you'd like to wait until the very end, I'll make sure to save some time and ask for questions then. But this is a great opportunity to be interactive and have a real dialogue around any questions you have regarding charitable giving. So please don't be shy, and let's have the conversation today. So I'll introduce myself first, and then I'll pass it over to Dave for an intro. My name is Ashley Fontanetta. The CAP next to my name stands for Chartered Advisor in Philanthropy. And that's a credential I earned a couple years ago when joining the team at Whittier Trust, about 4.5 years ago now. I have a background in mostly nonprofit management. That's been the majority of my career, just about 10 years. I spent working with nonprofits in LA and up in the Bay Area, focused mostly on supporting chronically ill children with arts and athletics programming. Since then, I went into financial services and was really thrilled to join the Whittier team a handful of years ago to work as part of their philanthropic services department. I will go on the next page. I'll tell you a little bit more about our company, but before I go there, Dave Cavell, do you want to introduce yourself to the group?
Sure. I'm Dave. Let me. I'll turn on my video too. I'm Dave Cavell. I've known Katie Brandon for a number of years, and she was nice enough to invite us to do today's presentation. Ashley, you're going to kind of credentialize the firm a little bit, I guess.
Yeah, you can share what you like, and I'll cover whatever you don't.
So essentially, just a 2-minute commercial here for Whittier Trust Company. Whittier Trust Company started as the family office for the Whittier family. And so what that means is we handle really all aspects of financial management for the Whittier family. And then in 1991, we opened up to non-Whittier family members to provide investment management services, trust services, real estate services, and what we call family office services, which is kind of all the soft issues that families need to take care of, like bill paying, making sure insurance is appropriate, if a client needs to hire staff and things like that. So those we fit under the family office umbrella. And then we have philanthropy, which is another part of our services. So we do this for families. We're a wealth management firm, and the focus is not only on their wealth, but on their family and their legacy. So it's really a very holistic approach. So that's who we are, and I'll turn it back to you, Ashley. Thank you, and thanks Katie for inviting us.
Thanks, Dave. So that's the overview of our company, and thank you, Dave, for providing that. I'll tell you a little bit more about my department specifically, philanthropic services. We all work as one team, but we do specialize in certain areas. And so our philanthropic services team, we come with backgrounds in nonprofit management, accounting, and corporate philanthropy. We oversee about $1.3 billion in charitable assets. That's just the charitable assets of our clients through vehicles like private foundations, donor-advised funds, charitable lead and remainder trusts, which we'll talk a little bit about today. We help them with planning their charitable strategies for how to make an impact, involving their family in their philanthropy, and then doing all the administrative work like running their board meetings, doing the compliance registrations, and making sure that the philanthropic entities that they have in place stay in good standing with the IRS and the Attorney General and everyone else who's looking. So it's a really great feature of our company, and it does, I think, motivate a number of our clients to be more philanthropic because they have us as their outsourced team to make all the work happen. We put out over 1,500 grants every year. We're a very busy group. So to get into the topic for today, I wanted to share what, the vocabulary of our field, sometimes called planned giving. It's really just another term for formalized philanthropy. It's when you choose to plan out and be a little bit more strategic and thoughtful about where your gifts are coming from, your gifts to charity, where they'll be coming from. And it's going beyond what most of us do or started doing, which is checkbook philanthropy. And that refers to, oftentimes you get a flyer in the mail. It comes with a little envelope where they want you to, and put in your check and mail it back to the organization that's seeking funds. Or, your neighbor knocks on your door and asks for a donation for their son's Little League group, or, you go to a nice luncheon for an organization and there's an ask at the end of the presentation, requesting contributions, so you write a check and turn it in. These are responsive philanthropic opportunities where you just write a check and you probably don't think about it too much after the fact. But for those who decide they want a little more structure around their giving, there's a shift from kind of checkbook philanthropy into planned giving. And it does have a lot of advantages. I think, two that stand out to me are that, one, if you'd really like to make an impact with your giving, it's sometimes hard to track where you've written your checks to throughout the year, what type of organizations they are, what cause areas they're in, and what difference is actually being made with the money that you've sent in to these organizations. When you formalize your philanthropy through planned giving, it's easier to make a strategy and stick to it, have a roadmap for what type of organizations you want to fund, what type of projects you'd like to support, and making sure that your contributions are traceable and trackable as part of the progress for the organization or the project that you're supporting. There's also a nice benefit that it does simplify charitable deductions. Instead of writing a whole bunch of checks throughout the year, through planned giving, more often you're doing some more thoughtful and planned out gifts where you can more easily track where you've given, and when the end of the year comes and you need to collect contribution acknowledgments for your taxes, it's coming from fewer places, or specifically if you've given to a private foundation that you've established or a donor advised fund, there's just one place you need to look to get your tax receipts. So that's a real advantage to formalizing your philanthropy. So oftentimes when you hear the term planned giving, there are a lot of misconceptions around that term. Most people think planned gifts are really big bequests or multi-million-dollar gifts that are being asked of you. It can seem intimidating or complicated, when in fact planned giving, at its core is really just referring to giving that takes your whole balance sheet into consideration and thinking maybe beyond cash gifts into other areas, other assets that you might be able to utilize to turn into charitable contributions. So it's about thinking beyond your checkbook, thinking about non-cash assets. And it's also taking into consideration both tax planning and estate planning, and seeing where contributions can fit in from there. You always want to make sure that you have enough and that you'll plan to have enough in terms of liquid assets available to you from now until the end of your life. And that you have enough to leave to your family, whatever amount you feel is appropriate. But for any amount beyond that, you can make some real significant plans to support the charities that you care most about. And when planned giving all comes together, what you find is that it not only has a benefit to your wealth and your wealth planning, your family or your personal values and feelings of connectedness, but also your legacy and your opportunities to give back to your community. Marrying all these three things together are the real goal of planned giving and thinking strategically about the charitable contributions that you make. So a couple options for planned giving. Some of these you may have heard of before, others might be somewhat new. But a bequest, that's a gift that's written into your will to one or more nonprofit organizations. It's always a good idea to let the organization know if you plan to leave them a bequest. They can first of all have a heads up and know that it's coming. They can make plans for how to honor you and discuss those with you, while they still are able. They also may be able to help you plan for other assets that you hadn't thought of. If you really want to make a nice contribution to the organization, they can help you look at the rest of your balance sheet and see if there are any other opportunities to give an even larger gift. An endowment is a gift where you as a donor make a contribution where you intend for the principal of that contribution to remain intact, be reinvested, and that the income that's generated from that amount, from that principal investment, the income is what supports your organization over time. Usually it's set up to last in perpetuity. So you're giving kind of a forever gift, a tree that will forever bear fruit for the organization you care about. And endowments also, there's some misconceptions that an endowment gift has to be a large, multi-million-dollar gift that puts your name on a building. And that's not the case. An endowment can simply be a contribution to an endowment fund with an organization where they've made a plan for those funds, not to be utilized, but just to generate income as a revenue stream for the organization. And these can be really useful for nonprofits, especially in lean fundraising years, like what we've just gone through with the pandemic, back in 2008-9 when we had the financial downturn, and nonprofits weren't seeing the type of charitable contributions from their donors that they were expecting or relying on. Those that had an endowment fund could tap into that revenue, that ongoing income stream, and weather the tough times. Another really great way to support an organization you care about is by naming them as a beneficiary of your retirement plan or your life insurance policy. It takes just a few minutes to go to your plan administrator, go to the forms where the beneficiaries are listed, and you can just type in the name of the organization, some of their tax ID identifying information, and then you're done. It's really as easy as that. You don't need lawyers to drop any paperwork or do anything complicated. And this can be a significant benefit not only to the charity, but also to you and your family personally. We'll talk a little bit about that later when we discuss gifts of retirement plan assets. Private foundations. I have a slide later that will show the differences between a private foundation and a donor-advised fund, which is the box right next to it. Both are grant-making entities. So both are charitable entities that you set up to fund with assets, invest them to grow over time, and then make grants out of that account as you wish. The private foundation does have more rules and regulations for how often you give gifts and, you know, what that looks like. The donor advised fund has less, I'd say, strings attached, less red tape and regulations. We'll show that in a later slide. But both are really powerful grant-making vehicles. And the designated fund, we'll talk about that in more detail later in the presentation. Charitable remainder trust and charitable lead trust. We also have 2 slides on those. So we'll go into more detail on those. And then alternative assets. It's a really great idea to think beyond your cash when making plans for charitable contributions. You may never have even considered making a gift of real estate. Maybe there's a cabin or a vacation home that you no longer use, or you're not really sure about leaving it to your family because sometimes that can create some family conflicts about who uses it, how often they use it, who's going to maintain it. So gifts of real estate are really powerful to be made to nonprofits. Gifts of art, collections, private equity. We'll go a little bit more into alternative assets. Before I move on from this slide, because I've just delivered a lot of information, are there any questions at this point?
And just unmute yourself if you have a question.
I have a question. Does Pasadena Village have an endowment?
Pasadena Village has a small investment account that's currently in CDs. I'll tell you part of the size of it. But you know, it's something that we can draw from in case of a harder philanthropic year. And you know, I think we have time to build on that, and we're only 10 years old, and so I think having a little bit of cushion is actually pretty good for a nonprofit of our size. Our budget is just over 200,000.
Right.
Thanks, Katie.
I wanted to
It's
ask.
never too late.
Okay.
Yes.
I wanted to ask one question. This is Betty Ann. I thought that there was a Whittier Foundation. Is there, or is it just the funds that you have and then you give grants, donor advised grants? Is there a
So
foundation?
we have, yes, the Whittier family has, I think 4 or 5 or maybe even 6 foundations that are attributed to their family that have been in place for decades. And yes, our office does oversee and manage and administer those foundations. But we have, let's see, so of those 5, we have probably about 40 other private foundations that we administer and manage, about 65 donor advised funds, 12 nonprofit endowments. So we work with a number of clients beyond the Whittier family. But our office was founded initially, our philanthropic services department was founded just to handle the foundations for the Whittier family. And we still do today.
Okay, thanks.
Mm-hmm. Okay. So now I'll get on to charitable swap. This is not my favorite dance move. Charitable swap is actually a really, it's really a neat planned giving opportunity. And so this diagram kind of shows you how it works. But it's something that's it's not very popular. It's not thought of very often. The way it works is that say you'd like to give a $100,000 gift to Pasadena Village. And so you look at your balance sheet and you say, okay, well, I've got $100,000 cash, but you know, I also have over $100,000 sitting in my investment portfolio. And most of that is really low basis stock. You know, my buddy Jeff Bezos, when he started, he founded Amazon, he called me up and said, hey, I've got a hot tip for you. And so I've got this really low basis Amazon stock that has generated a lot of unrealized capital gain in my portfolio. So what you can do is take your intention of giving $100,000 to Pasadena Village. You can do that by giving directly a gift of your low basis Amazon stock directly to Pasadena Village. And then what you do is immediately take the $100,000 cash that you were going to give to them, use that to immediately go back and buy $100,000 worth of shares of Amazon. So what you've effectively done is replace the exposure to Amazon in your portfolio by stepping up the cost basis from what it was when it was really low when you first acquired it to where it is today at the same value amount. And you've accomplished your goal of giving the value of $100,000 to Pasadena Village. So it's a pretty neat trick. It's a pretty neat way that you can make a very effective gift to the nonprofit that you care about, but also make a nice impact on your investment portfolio to get rid of some of the capital gain that you would have had to, if had you sold the Amazon stock and perhaps wanted to give from those proceeds, you would have had a massive capital gain tax. So in this case, you're replacing that capital gain liability and still making a really nice, generous contribution to Pasadena Village. And this works with any dollar amount. The $100,000 in the example here is just an example. It works with any dollar amount. The key is low basis stocks. So check your portfolio and see what you got in there. Okay. Next, we'll talk about non-cash assets. And this is, like I said, a lot of times as a donor, you don't think first. You think first about, okay, charitable contributions. Someone has asked me to contribute to a charity. I guess I could think about my budget and how much I'm comfortable giving this month or this year from my checking account. You can make usually larger and more impactful gifts if you think beyond cash. Stock is one of the first places that I recommend donors take a look. Not only for reasons like the charitable swap we just talked about, but giving gifts of stock does save you from paying an eventual capital gain on the stock should you sell it yourself in your portfolio. You can gift it directly to a nonprofit organization and let them sell it, because nonprofits are tax-exempt organizations. They don't have any capital gains on the sale of the stock you've gifted to them. So rather than selling stock in your portfolio, you have to pay the capital gain on it and then give a lesser amount to your organization. You give the stock directly to the nonprofit, let them sell it at no capital gain, and they've retained the full value of the contribution that you wanted to make to them. Also, collections of art, other types of collections like coins, guns, other valuable collections like that. With an appraisal, those can make really nice gifts to a nonprofit organization. Real estate, as I mentioned, can be massively impactful to a nonprofit. And even if the nonprofit is not in a position to accept a gift of real estate, there are other middle grounds you can work through, like a donor advised fund, to make the contribution, sell it, and then use the proceeds to support the nonprofits that you care about. Private equity, royalties, oil mineral interests, sports teams. I included sports teams because we actually have an example of, it's not one of our clients, but a client of a community foundation I work with gifted the Kansas City Royals to a community foundation a number of years ago. So you just never know, but non-cash assets can be really powerful. I put the stop sign on here because once you've identified something that you could, potentially utilize as a charitable gift, it's really important to first talk with a tax advisor and talk with a philanthropic advisor, someone to help you understand how best to package and deliver this contribution, because it may have to go through an intermediary vehicle. But most importantly, talk to the nonprofit organization. Make sure they understand the intentions of your gift. Make sure they're in a position to accept your gift or determine if there's some middle ground or something else, a middle step that needs to be taken before the proceeds of this contribution can be gifted to the nonprofit. Okay. We talked about gifts of retirement assets, and this is just one example of the tax difference it can make to you and your family for gifts of, in this situation, a traditional IRA. So in this case, if you wanted to leave $100,000 to charity after both you and your spouse pass, you have a traditional IRA, you're thinking, okay, well, my goal is to leave money to charity, but I also have a child that I want to make sure is taken care of. So I want to leave money to both my favorite charity and my child. In scenario one, the way you go about it is that you leave $100,000 to charity through your revocable trust, and then $100,000 to heirs as part of your traditional IRA. What happens is that the money goes straight to the charity, they get their $100,000, but what happens for your child is that they receive the cash value of your retirement account minus their tax bracket, minus the taxes that are due on that amount. So net, your child is coming away with $76,000 instead of the $100,000 that you intended. What you can do instead in scenario two is just switch the order, switch the place in which the money is coming from. The source of the funds in this case really matters, because you can leave your $100,000 to charity by naming them as a beneficiary of your IRA, and then gift the $100,000 to your son through a revocable trust. What happens then is that the money still goes straight from your IRA out to the charity. They pay no taxes, but the benefit here is that your child, in this case, also gets his inheritance free of federal taxes. So it matters. The source of the fund matters. It matters where the money is going to come from, especially in this type of scenario. This is the chart I mentioned earlier, comparing a private foundation and a donor-advised fund. Donor-advised funds have really been on the rise in popularity in the past 15, 20 years, probably really, making their mark in the past 5 or 10 years. But they do basically the same thing. They're grant-making entities to nonprofits. And they allow you to as a donor, make a contribution of whatever kind of asset, receive a tax deduction up front. So you receive your tax deduction immediately, and then you have this account of charitable funds that are tax exempt. They can grow and generate more income tax free, and you can use them to make charitable gifts to qualified organizations. Now, there are significant differences also between the two, and this chart outlines a handful of them. But what I think is most important here is that if you're in a position where you're thinking, okay, I'd like to establish a private foundation or maybe a donor-advised fund, I'm just not sure which one to choose. There's 3 important things that you should consider first. One is, what type of grants do you want to make, and to what kind of organization? So thinking through what your giving is going to look like. Second, how much time do you want to have and commit to being involved with this grant making? Whether it's you or what you intend for your family to step up and be involved with. Is this something you'd like a lot of hands-on activity? Would you like to maybe hire family members to operate and manage this grant-making entity? So thinking about family involvement or personal involvement and what that looks like for you. And the third thing to consider is, what assets are you going to use to fund this vehicle, both initially and in the future? The answer to all 3 of those considerations will point you in the direction of which vehicle is the best fit for you. And we have a lot of clients that they start out with one and they end up establishing the other later on for different reasons. So you can always do both, and these 2 vehicles work hand in hand really well together. It's nice to have a private foundation and a donor advised fund, because there are some advantages there to utilizing both. But it is important to think through, if you want to just have one entity, if you open up a private foundation, there's a lot of time and cost it takes to draw up the formation documents for this. And so you want to make sure it's the right fit before you commit to that type of investment. And while a donor advised fund, it doesn't really take a lot of time or resources to set one up. You can do it pretty quickly and easily. It's irrevocable. Once it's a donor advised fund, you can't do anything except transfer it to another donor advised fund. So if you choose the donor advised fund route and then decide later that it's not the right fit for your grant making, unfortunately, those funds are committed to being a donor advised fund. It can't turn into a private foundation from there. So this is another good opportunity to talk with your tax advisor, talk with a philanthropic advisor, lay out your plans and what your vision is for your philanthropy, and make sure that you're getting started on the right foot. I'm not going to go through this in detail, but we'll, again, make the slides available after the presentation. But this is just a quick aside to point out that when choosing a donor advised fund host, donor advised fund is held by or hosted by a nonprofit, and that's what makes it a tax exempt account for you. Not all are created equal. You can find donor advised funds available to you through institutional kind of brokerage firms, through community foundations, through other private organizations. They all operate slightly differently, and so it's important to investigate and compare, at least a couple, and make sure that you're finding out that the way in which the donor advised fund will be managed is in line with your wishes. Can it be passed down within your family for multiple generations? Can it accept certain types of assets that you plan to give to it? Are there any other rules around how the donor advised fund will be administered? So just a thought there and some questions to ask when choosing a donor advised fund host. The last one before I pause for some more questions is to cover the donor designated fund. This one's not very popular. We don't get a lot of people talking about donor designated funds, but it's kind of like the cousin of a donor advised fund. It looks and feels a lot like a donor advised fund in that it is like a charitable checking account. It's an account where you can put your money in, you get the tax deduction right up front, and then those funds can be reinvested to grow over time. They don't have to be paid out in any regular periods or amounts. And the difference here between the donor advised fund and the designated fund is with designated, you can remember it from the word designated, you have to designate a recipient charity from the outset. So when you set it up, you say, this is my donor designated fund to Pasadena Village. And forever, as long as funds are in that account, they can only be used to make gifts to Pasadena Village. Now, as I mentioned before, they don't have to go out in any type of frequency or any type of amount per year. They can sit and grow over time and then distribute out when they reach a certain value, whatever you envision. But the idea is that it's all meant to benefit just one nonprofit organization. The thing that's really neat about donor designated funds that make them, I think, a little more attractive than a donor advised fund, if you have one charity that you want to support, is that you can contribute from your IRA into a designated fund. You cannot contribute from your IRA to a donor advised fund. So if you think about it, the IRS likes to reward restrictions. So where there are more restrictions placed on the type of charitable vehicle, you get some tax advantages. And in this case, the opportunity to make gifts of up to $100,000 a year from your IRA into a designated fund, where it again can be reinvested, it can sit and grow, and then go to your designated charity, can really, greatly grow the impact and size of a charitable gift that you plan to make. There's also another benefit right now that's one of the limited time opportunities I'll talk about at the end of the presentation through the CARES Act, which specifically, also is a good reason to think of using a designated fund. Okay, so I mentioned I would pause for questions. If there are any, please do speak up. Otherwise, we'll move on to charitable remainder trust.
Ashley, I'm not very familiar with donor designated funds. So if you choose several charities, do you have to choose a percentage, or that's a choice you make later?
So it depends where the designated fund is hosted. They have different rules about whether or not you can have one fund for maybe 1 or 2 or 3 charities. Most often, you'll need a specific fund for each charity. If there's multiple charities, you have multiple funds.
Thanks.
That's most often the case. But this is really cool, and I'll highlight it again. The gift from your retirement accounts to the designated fund is really powerful, especially if you're taking required minimum distributions, or RMDs. Prior to 2020, I think it was for those who are 70 and a half and above, start being required to take distributions from your IRA. Now it's those over age 72 have to take RMDs. But so you're getting this distribution, which comes to you as ordinary, it's taxable as ordinary income. So it's great, but you're paying taxes on it. If you're charitably inclined and you want to make charitable contributions anyways, you can direct those RMDs straight to a charity or into a donor designated fund. If you don't want that amount to go outright to charity right away, you'd rather build up an account that can maybe grow even bigger and benefit your charity, you can make RMD contributions to a designated fund.
I have a quick question. Are you saying that if you wanted to give a donor advised fund, say to the Pasadena Community Foundation, you can't give appreciated stock and avoid capital gains on the money you're putting there?
So the goal, let me clarify the question. So the goal would be to make a gift of appreciated stock to Pasadena Village?
No, to the Pasadena Community Foundation as a donor, and then have it be a donor advised fund.
Yes.
Yes,
you certainly can't do that.
You could avoid the capital gain.
Okay. That is correct. Yep. A donor advised fund, just like a private foundation, those are tax exempt entities. So if you were to sell that stock personally and then make the contribution of cash, you would have personally made yourself liable for the capital gain on that stock. Right. So the best opportunity is just make the stock gift directly into your donor advised fund or directly into a private foundation and let them sell it.
Thanks.
Yeah, that's exactly right. Any other questions? Okay. Then I'll get into, rather quickly, I'll go over charitable remainder trust and charitable lead trust. Only because these are pretty complex vehicles, but I wanted to introduce them at least, through this presentation. These are oftentimes known as split interest trusts. And the reason they're known as split interest is because, on one hand, a charity or nonprofit benefits, and on the other hand, you as the donor or your family benefits. It's kind of a win-win situation for charitable giving. So with a charitable remainder trust, what you want to keep in mind is that you set it up to produce an income stream that goes back to you or to your heirs over time. You make a contribution into the remainder trust, which is tax exempt. So this is a great opportunity to put things like appreciated stock or anything that's going to have a lot of appreciation on it. We have a lot of clients that will put in interest in a privately held business before it goes public, or pieces of real estate. Things that if you were to hold and sell them yourself, there'd be a big tax liability, but instead you've put it into a remainder trust, which as a tax-exempt entity can sell it at no tax consequence and then reinvest the full value into a diversified portfolio. So that's a real big tax advantage there. Then the remainder trust is required to pay out regular payouts, to make a regular stream of income to the person that you've named, to your heirs, or can sometimes come back to yourself. But keeping in mind that the income stream is it's important, it's necessary to this vehicle. What happens is after a period of time that you've set up for the trust to exist, it's paid out regularly to your non-charitable beneficiary, and then at the end of the term, whatever's left in that remainder trust, which has been reinvested to grow over time, that goes to the charity or the donor advised fund or the private foundation of your choice. So the reason this is a real win-win is that you as the donor can have a real tax advantage to making a contribution to something that generates income for you for a period of up to 20 years or for the rest of your life. And at the end of the day, it's grown to an extent where it's going to make a sizable gift to charity. So this is split interest, a win-win for both you and the nonprofit. There's a little disclaimer down here at the bottom. Again, I mentioned there's a lot of fine point detail to these vehicles, to this and the next one, the charitable lead trust. So, please understand that this is not tax or legal advice. And your particular situation, if you choose to use a vehicle like this, really needs to be discussed with your professional advisors. But this is kind of the general overview of it. For example, when the income is coming down to your donor or your heirs, it is taxable. So the tax does eventually come back to you, but it's done spread out and over time. So again, there are fine points to this vehicle, but it is, I think, still a really cool win-win opportunity for both the donor and charity. Okay, so when you think of charitable remainder trust, you think of income stream. When you think of charitable lead trust, I want you to think of passing money down intergenerationally. This is kind of the benefit of a charitable lead trust, which what it's doing effectively is swapping out who gets the money first. In the previous scenario, the donor or the donor's family got the money first, the charity got the money second. With charitable lead trust, your charity gets the money first and your family gets the money second. So those are two real distinguishing characteristics. Furthermore, the charitable lead trust, because the lead trust itself is not tax exempt, it has different types of tax benefits, more so for gift and estate tax planning. So if you're interested in supporting a charity or maybe funding a family foundation or donor advised fund, and your goal also is to pass assets to the next generation of your family or to your heirs outside of your taxable estate, using a charitable lead trust is a really powerful way to go. So again, there's the fine points to a vehicle like this. It takes significant planning, especially if you, as part of your estate plan, want to use it as a tool to get money out of your estate and down to your heirs. So this is not a do-it-yourself type of tool. This is something you really need professional advice on. But I did want to introduce it because it's something that's not utilized that often. It's not that popular, but it's really powerful if you want to make a significant gift to charity and get significant money down to your heirs. Here's just a follow-up on the tax considerations for charitable lead trusts. Like I said, the trust itself is not tax exempt as the charitable remainder trust was. There are two different kinds of trusts, and they're taxed differently, both the grantor and the non-grantor lead trust. This slide, is kind of a takeaway as you review the information after today's presentation. I won't bore you with it all today, but just know that, again, the charitable lead trust is really powerful, but very nuanced, and all of your tax considerations should be considered before moving forward. Okay, so now for just the two limited time opportunities that I wanted to bring up with regard to charitable giving. The first is, as you've probably seen in the newspapers and is being discussed, ad nauseum these days, what's going to happen with the rate of the federal estate tax right now. The administration has, there's numerous proposals out there, and so we'll see kind of where it goes. But currently, if you're subject to federal estate tax, there's a lifetime exemption that's the highest it's ever been. It's at $11.7 million per person. So if you're married, double that amount. That's the highest it's ever been. And so there's been some really great planning opportunities to, utilize that exemption up to this point. When it was put in place, it already had a sunset date. So we knew there was a limited time for this really high exemption. It was going to end December 31st, 2025. So starting in 2026, what will happen is that really high exemption will revert back to where it was previously, closer to 5.5 million. So again, being subject to federal estate tax means that you'll have net, assets in your estate, your gross estate will be valued at or over about 5.5 million. Anything below that amount, you can, you can gift, you can pass down, to your loved ones that you're passing. Anything above that amount is subject to what currently is a 40% tax, and that amount, that percentage amount may even increase. So what we do is, for most of our clients who are in this position, we look for opportunities to say, okay, if you don't have a charitable plan for the assets that are subject to estate tax, the plan is that the government's going to take it and use it as tax and, pave our roads and maintain our electric grid. But if you'd like to have a say in the fate of your hard-earned assets, the only way to avoid the estate tax is to leave the remainder of your assets to charity. And so there's significant charitable planning opportunities that can be implemented, and it gives you as a donor a lot more control and say in where your hard-earned assets are going to go. Last thing I'll do just to wrap up is talk about the CARES Act. This was enacted in 2020 and then was extended in 2021. Certain provisions of it were. And one that was extended in 2021 is that cash gifts to a public charity can be deductible up to 100% of your adjusted gross income. And this is a tremendous step up from the previous deductibility limit of 60%. So from 60% up to 100% of your AGI can be deductible for cash gifts to public charities. And I mentioned before in the donor designated fund that it has a CARES Act tie-in. This is it, because if you don't intend for such a large gift of cash to go outright to a charity, you can place it into a designated fund where it can be invested to grow over time and work as then kind of a charitable checking account for the nonprofit you've designated. But it doesn't all have to go in one lump sum. And then once that's set up, you can also use it for your RMDs. So anyhow, I hope that was helpful. I know it was a lot of information, and we are about 4 minutes from our end time. So if there are any questions, I'd love to turn it back to you for anything else that I can help with.
Could I start off with a very simple question, since a lot of this is a little bit over my head? If you have things and rather than cash, in other words, a retirement account, investments, and property, is the general rule that if you just leave those things to the charities, then they won't have to pay the capital gains on it?
Yes, that's correct, with the caveat that not all charities are set up to accept some of those assets you just mentioned. So it's always a good idea to talk with the charity first about the type of things that you might think of leaving to them. And as I mentioned before, there might be a middle step, an intermediary step, where you as the donor set up a donor advised fund, for example, to accept assets that will then be sold. And once sold, the cash proceeds go straight to the charity of your choice. In both cases, going to the donor advised fund or going straight to the charity, the full value of your gift will remain intact. It will not be eroded by capital gain tax.
Okay. So it's really of no advantage to the donor to cash out on everything, or to instruct in their will or trust to say, just convert everything to cash and leave it to so-and-so. That's not to the donor's advantage.
Correct. You always want to make your gift to a tax-exempt entity. Mm-hmm.
Anybody else want to know what to do with their millions of dollars?
With the CARES Act, so I understood that in 2018, we lost our charitable deduction unless it was above our, the higher deduction that people got. So what are you saying in 2020? That anybody can take deductions or not?
So there was a difference for the information I presented is for those who itemized their deduction. There was an increased amount of non-itemized deduction made available in 2018, and that remains the case. But for those who do itemize, the new rules can apply.
Okay.
And we expect that the increased deductibility for cash gifts will sunset at the end of this year and go back down to 60% of your adjusted gross income. I share all of that. When I have this conversation about deductibility and percentage of your adjusted gross income, that's usually an amount that's far above and beyond what your average donor is planning to gift. So unless you're looking at a significant gift, which may be a significant percentage of your adjusted gross income, then it's important to keep these limits in mind. You can carry forward any amount that goes over those amounts for up to 5 years. But generally speaking, for your annual gifts that you're typically making, they're not near maxing out your deductibility limit. So it's nothing to really worry about. Just something to kind of keep in the back of your mind.
I have a question.
Go ahead, Barbara.
Yeah. If one donates, for instance, a piece of property or stock to an agency, to a nonprofit, that nonprofit would have to have a broker, would have to pay whatever in order to sell these items. Am I correct?
Correct. They would need a brokerage account to be able to accept and then sell what you've given them, which is why even for gifts of stock, it's always a good idea to contact your nonprofit first and see what they're set up to accept, and see if they're in a position to accept that type of donation. A good intermediary is a community foundation. Many times, if you have or set up a donor advised fund with them, they're usually pretty low cost to set up and maintain. It can act as a pass-through for your gifts of stock, where the community foundation DAF can accept your stock and sell it, and then gift it to an organization that is not set up with a brokerage account, and they just get the cash.
But I know that the village is set up to do that already, because
Great.
somebody, I mean, you don't really, all you need is an account and somebody gives appreciated stock, because that happened a couple of years ago.
Yep.
It doesn't, there's
Yeah,
no,
and in that case,
yeah, there's no fee.
great. Yeah, and so knowing that Pasadena Village can accept gifts of stock, it's a great way to support them.
Wayne, I've got a comment.
Sure, go ahead.
So years ago, I made a significant gift to my School of Nursing. It was through the Cal State University system. And they did let me give my stock as probably half of the gift, and it went seamlessly.
Now, when it comes to what happens in 2026, that just involves your heirs as far as family and so forth. That doesn't apply to charitable giving.
That doesn't apply to charitable giving unless you're planning for any amount above that exemption level of about 5.5 million. If you want to direct it to charity yourself, and instead of letting our tax system direct it to the greater good.
Any other questions?
Yeah, I have one other question. Some years ago, my husband and I donated some stock through the community organization, and was vastly appreciated stock. But by the time it was sold, which was maybe almost a month later, the value had declined. But also, as I recall, there were fees for selling the stock. It was so many years ago, I'm not quite remembering. But what I do remember is that the value of the stock had gone down because of the lag between the time we had gifted and the time that it was sold. So is this typical for if there'd be such a lag in selling stock that is received?
Yes, and I'd say it's not typical, but it is, I think, a great reminder of the importance of communication with the organization you contribute to convey your intention that the gift should be sold immediately. It's a best practice in the conventions of accepting gifts of stock that you want to sell it immediately, because you need to capture the full value of the donor's contribution. So that is the most commonly utilized practice, but it does come with, I think, some responsibility to remind the recipient that that's your intention, that they sell immediately.
Yeah, this was
I've had, on the other hand, contributions come in and the donor says, under no circumstances do I want you to sell this. And that decision actually has to be documented so that we know the responsibility for that was requested specifically by the donor.
Yeah, as I recall, this was a community foundation. It wasn't to a particular agency. And the response was, oh, we do this. Yeah, they have some kind of schedule about when they sell their stock.
So that's really interesting.
There's-
Barbara. At the Arboretum, we had a beautiful garden actually made because of someone's contribution of stock, and they contributed in the morning, and by the time we sold it in the afternoon, it was still, I mean, it just shows the volatility of the market, so we had to figure out which part the donor could take the tax advantage for and which part we could credit their gift, because there were different amounts from the morning till sold it at 3 o'clock or whatever.
Yeah, well, according to, again, this was so many years ago, but as I remember, what I could deduct was what they had sold it for. But there was no question about that.
Yeah, and oftentimes what they'll do is take the average value for the day. They'll take the
Really?
opening and the closing price and they'll average it out, and that's what you get. There's a lawsuit that's happening right now, actually, for in the opposite situation where the contribution was made and it was the community foundation's policy to sell right away. But the donor didn't intend for that to happen. The donor knew that the stock would appreciate. And so they intended for it to remain intact, and it was not. And then now they're suing the community foundation. So it all has to do with gift acceptance policies. What you've mentioned, Barbara, is that this organization had a policy to liquidate probably once a month at the end of the month. It's always a great idea to ask for a copy of your gift acceptance policy and take a look at it and make sure it's in line with your intentions. Unfortunately, I'm sorry, I know hindsight is 20/20, and I wish everybody, knew this at the outset. And it's incumbent a bit upon the fundraising professionals at these organizations to know of these rules and to know of these things that could happen and really disclose a lot of that in advance. But many cases, the nonprofits don't know of these circumstances that they can arise until they do, and then it's too late.
Okay.
But I know Katie can always give us a call if she needs any tips, and I'm sure she's well situated and has this all under wraps anyway. But reaching out to philanthropic advisors is always a good idea.
Okay, any other final questions? Going once, going twice. Okay, thank you very much, Ashley, and also David. You were here to provide moral support.
That's exactly right.
And thank you, everybody, for attending. And we'll go ahead and wrap it up. So I'll go ahead and close this out.